Imagine if I told you that we're on the verge of witnessing a stock market crash. Warren Buffett foresees this looming event, but did you know there's a way to turn this problem into an opportunity? Firstly, Warren Buffett openly acknowledges the risk of a stock market crash. Market ups and downs are cyclical in nature, so bear runs should be expected. While no one, including Buffett, can predict what lies ahead, he does advise us against selling stocks in a downturn. Quite the opposite. While Buffett has always reminded investors that we can't ignore the possibility of eventual stock market crashes, he is also famous for his view that downturns are the perfect time to acquire stocks in undervalued companies, capitalizing on their relatively low valuations. As investors, we should expect the market to have downturns. They are part of the cycle, and it's not just about the impact of COVID-19 or the ongoing war in Ukraine. According to Buffett, fear is a big player in causing crashes because people start freaking out and making all sorts of impulsive decisions when they're not thinking straight. But Buffett and his partner Charlie Munger have been riding these market waves for years without letting fear get to them. They've mastered the art of keeping their cool. Buffett even says that emotional control is key to making it big in the stock market, although he admits it's easier said than done for most folks. Buffett believes that if you want to succeed in investing, you must keep emotions in check, stay rational, and avoid making impulsive decisions fueled by fear or panic. And Buffett himself is a master at keeping his cool during turbulent times, and that's a testament to how important emotional discipline is for investment success. A good example of embracing change is when Buffett sold his company's stake in several airlines in 2020, Southwest, Delta, American, and United. He initially bought them for $8 billion, but as things changed, he sold them for $6 billion. People were actually being advised against flying, which created an unfavorable environment for him as a shareholder. A major strategy for investing during market downturns is to stick to the basics and assess a company's value, and this aligns perfectly with Buffett's long-standing principles of value investing. Buffett has always been focused on carefully evaluating a company's fundamentals and figuring out its real worth. By following this strategy, investors can avoid paying too much for stocks during bull runs while lowering the risk of major losses when the market takes a nosedive. Patience and disciplined valuation analysis are key. Buffett also encourages investors to expect the unexpected. He wants us to remember that markets are cyclical yet unpredictable. Even though there may be historical patterns and trends, things can certainly take unexpected turns due to unforeseen events, causing major market swings and crashes. Simply staying prepared and building portfolios that can handle whatever comes our way will help investors stay confident in downturns. Buffett has always encouraged continuous learning and adapting to new circumstances, and that's a lesson we should definitely take to heart if we want long-term financial stability. When it comes to borrowing during a crisis, Buffett points out the potential benefits of getting low-cost capital when there are some sweet investment opportunities on the horizon. By using debt wisely, investors can take advantage of undervalued assets or distressed companies during economic turmoil. But tread carefully and assess the risks before taking the plunge. While Buffett has made successful moves using borrowing in the past, it's worth noting that too much debt can be risky, especially if market conditions take a turn for the worse. Buffett encourages investors to expect the unexpected when it comes to those stock market crashes. He knows that the United States and global markets have faced economic downturns in the past, and according to him, we must keep improving and making smart decisions based on the lessons we've learned from previous crises. It's all about growing and getting better. Warren Buffett's warnings are like gold nuggets of wisdom for investors. He sheds light on the possibility of future stock market crashes and offers some valuable advice. By understanding how fear influences investment decisions, evaluating the true value of companies, being prepared for unexpected events, and making smart borrowing choices during crises, people can navigate the complexities of the stock market with more confidence. Buffett's long-term mindset, focus on emotional control, and dedication to continuous learning are timeless principles for successful investing. By incorporating these teachings into their investment strategies, individuals can increase their chances of achieving financial prosperity in the long run.